Wall Street's fear gauge, the VIX, is sitting at between 17 and 18. That's calm. That is quiet. That's a kind of number that lulls everybody to sleep. And here's what I want you to sit with for the next 15 minutes or so. The calendar says this quiet has a shelf life. We are standing on the exact spot on the map where year after year volatility tends to wake up. This is not a threat. This is an output because the people who see the season change coming get to prepare while everyone else is still at the beach. So let's take a look at this chart together. But quick thing before we dig in, if this is helpful to you, hit subscribe to the Black Swan channel. That's what keeps these breakdowns coming. And if you want the full playbook, the exact level, the portfolio, the position, what I'm doing every day, join as a member. I'm offering up to 10 separate tools for your use. Join the Patreon channel. First, let's start with the calm before the calendar. Let's start with what's actually happening this week because context matters. As I record this, the VIX closed Friday at around 18.58, and today is drifting down to 17, down about 4.5% on the day. The trigger was simple. The United States and Iran announced a pause in hostilities and futures caught a bid. Fear came out of the market. So step back and the picture is even calmer. The S&P 500 is trading around 74, 71 right now, right? Near record territory. The NASDAQ is around 25,200. Stocks are strong and the fear gauge is sleepy. That is a summer that we've had. Now, here's the part that rewards a little memory. Back in the spring, the same VIX spiked towards 28 to 30 during a bout of tariff and geopolitical stress. Remember that? Then right on cue, it melted back down through June and into July. That slide into a summer lull is not random. It is one of the most repeatable rhythms in all of markets, and it's exactly why this next chart is built to show you. And I want to flag the emotional trap here because it catches almost everyone, right? When the fear gauge is this low and stocks are this high, it feels like nothing can go wrong. You know, that feeling, that comfort is precisely the moment the calendar starts whispering, not to scare you, to prepare you. So let's stop feeling and start reading because the chart takes all of this out of the realm of opinion and puts it into a picture. Take a look at this chart. This is the single most important picture I'm going to show you today. So let's take a look at it very carefully. Imagine you recorded the market stress level every single day for 35 years. Then average it out by time of year. What shape would it make? The chart is the answer. And the shape tells you a clear little tail. There is a small bump of nerves in the spring around March and April, as you could see, little red line, right? Then things cool off into early summer. Now keep in mind that you're looking at three lines here, right? The thick gray line is the average VIX for each part of the year blended across 1990 to 2025. That's the thick gray, the dark gray line, right? Then the market typical mood by season over the past 1990, 35 years. And the dashed line, right, is the same average, but with the two craziest year, 2008 and 2020, taken out. So you could see the everyday rhythm. And the bold red line is 2026 so far. So let's take a look at what the gray line does next. From August, it starts to climb, keeps climbing through September, and crests around October, the highest stress part of the calendar. And then, like clockwork, it eases back down into a quiet December. I mean, this is what history tells us, and so far we are kind of very close, right? So when you hear me say we are at the trough, that is what I mean. We are sitting at the bottom of the bathtub, and the historical shape of the water leans uphill from here. Not straight up, not violently, but uphill. Understanding that one shape changes how you read every headline for the next 90 days. Now keep in mind that there are ways for you to benefit, and I know I'm going to take advantage of. There are ETFs that trade off that volatility, and my members get to see it in the portfolio that I'm currently building. This is education again. This is not prediction. We need to educate ourselves to understand what's happening so we don't get frightened by what's going to be happening right around the corner. Take a look at this interesting bar chart. Each bar is the average VIX for that month. The red bars, September, October, November, are all the tall ones, as you could see. A historically jumpy stretch. And the green bar, June and July, are the calm valley. The dash code line is the long-term median, so you can see which months sit above and below the market's normal temperature. So let's put some history behind the shape, because this pattern has serious receipts. October is statistically the most volatile month of the year, and it is in close. It has hosted the largest single swings on record going all the way back to 1930. Black Monday 1987 was October. The heart of the 2000 crash was October. September and November sit right behind it. Now, I know that sounds scary, but I want you to flip it around, because this is the whole reason the channel exists. Every single one of those autumn spikes was also a doorway. In 2011, the VIX jumped towards 43 during the European debt scare, and the folks who had cash ready bought a bottom. In 2018, it popped past 28, and again, patient buyers were rewarded within months. The lesson from 35 years of history isn't autumn is dangerous, run away. The lesson is autumn is when opportunity goes on sale, so have your list ready. Volatility has never been the villain of this story. Being caught unprepared is the only villain. And you watching this in July, anything but unprepared. Like I always said, volatility is not loss. So pay attention, understand what's going on, and learn. Now, let's take a look at this other chart. This is a yardstick of the whole VIX range. Far left is a record low near 9. The green zone is calm. The gold zone is elevated. The red zone is stress. The teal marker is where we are today at 17.76, sitting just above the long-run median of 17.62. It is a quick way to see that on its own history, the fear gauge is currently pretty ordinary. Lots of room above it. So let's get under the hood, right? Because why the season exists tells you when to trust it and when not to. A few plain reasons. Summer trading is thin. Desks are half empty. Volume is light. Quiet market stays quiet. Then autumn arrives with earnings season, fiscal, budget deadline, the portfolio managers who start to de-risk to protect their year. More decisions, more headlines, and more movement. There's also a deeper force at work, mean reversion. So basically, think of the VIX as a rubber band. Stretch it way down towards calm and tends to snap back up. Stretch it way up in a panic and it tends to relax. So right now at 17.7, barely above the median of 17.6, the band is pulled gently towards the low side. That doesn't guarantee a snap back tomorrow, but it tells you which direction has more room, right? So now the honest caveat is, because I never want you to, treat a tendency like a timer. First, on the original chart, there are two different scales. One axis for the long run average and a separate axis for this year's line, which is a way to compare shapes when the levels differ. And second, they deliberately removed 2008 and 2020 in one of the lines, so two once in a generation panics don't distort what a normal year looks like. And third, the big one, seasonality tilts the odds. It does not set the date. Some autumns, like 2017, stayed calm the whole way. So this is a lean, not a law. Respect it. So hold both ideas at once if you can, because that's the way, right, or to invest. On one hand, the season leans uphill. The odds favor more movement. And in a medium year, the lean is on a toughest, it's on a tough steeper, right? On the other hand, it's a lean, not a guarantee. And low fear today is actually a healthy backdrop, not a warning siren. Both of those are true. Understanding lets you carry with attention without turning into panic. So let's find out, what you can actually do with this. So plainly speaking, picture a barbell. On one end, the heavy weight, the great majority of your money stays in your solid, boring long-term holdings. You don't touch those to share, to chase a season. On the other hand, a small weight, a slide of opportunity, cash on hand. Then 4 steps, and they all happen now. While things are calm. 1, build your shopping list. I have given my members 2 lists, my Black Swan portfolio, stock portfolio, and ETF portfolio, and the specific things you'd love to own cheaper. 2, decide the price you'd be thrilled to pay. 3, keep some dry powder. Don't be fully invested with zero flexibility into the jumpiest part of the year. 4, if the VIX does climb in the 20s and beyond, that's actually exactly when your list goes on sale. That's your green line, not your panic button. That's the whole mindset. Volatility is just the toll you pay to buy wonderful things at a discount. So let's bring this thing home, right? So today the fear gauge is at 17.7, calm, quiet, right at the summer trot. The calendar leans toward more movement into September and October, and a midterm year like 2026, that lean is a little steeper than usual. But steeper isn't scarier, not for you. Our base case is a perfectly normal seasonal bump, right? Our real hedge is simply being ready across all 4 paths so that whatever autumn brings, you already decided how you'll respond. That is the entire difference between fear and opportunity. That is the season for the prepared. So get your list ready, keep some powder dry, and let the calendar do the rest. If you found this video helpful, don't forget to give me the thumbs up.